Okay, good evening. Yeah, welcome to this CAIA demo lecture and information seminar for the date of March 2021, which is March next year. Okay, my name is Yuen, Larry Yuen. And here is a bit of background of myself. Yeah, I'm the trainer at Kaplan for both the CFA and the CAIA examination preparatory course. So, of course, this evening we're going to focus on the CAIA, the CAIA examination preparatory course. I started off in the asset management industries, managing this portfolio, balanced portfolios, mostly investing in the traditional investments. In those old days, we didn't have much choices in alternative investments. And moving along, and when I come to the second half of my career, I started to do this product specialist role on various types of funds, including all these different kind of alternative investments, which gave me the opportunities to have the exposure, to various types of hedge funds, private equities, and other alternative investments as well. So what I would like to do today is, firstly, we do an overview on the markets, the growth of the AI, alternative investments, and what's the trend going forward, and where are the where did the investors put their money into, when they choose the AI investments. And then we look at the examinations of CAIA, what they required, what exactly included in the curriculum, the syllabus, and what we think is the way to tackle the examinations effectively. Okay, and to demonstrate that, we have a few slides here, which we used for the classrooms, face-to-face classes, to show to you how we handle these different topics according to the requirements of the CAIA curriculum, so that you can have a taste as to what we mean by effectively to focus on the curriculum requirements when we prepare for the exam. And lastly, I will pass it to my colleague, and they will have more details for you as to what kind of offerings, different types of courses, choices, options for you to choose to make use of the resources at Kaplan's to help you to enhance your preparations for the examinations. Okay, so that is the agenda for today. Okay, let's take a look of this market first. Alternative investing. You say it has grown, evolved. Certainly. Because AI has a pretty long history, and by now it has grown to a certain stage. It is not just a new market. It is kind of a mature market to a certain extent, and but then again, it evolved. From one stage to the other stage, and that has attracted a lot of different people's participants' interest. Like here, we have different type of companies, right? They are more interested in the AI investings. In the retail markets, we have more product structures available for the investors, and all these different kind of institutional investors and also government entities. They all have interest in AI. But of course, for different reasons, right? For the investors, we also have, we have students from each of these different categories, of groups of interest. We have students coming from a family office, for example, that they would like to know more about this AI, and they want to diversify. They want to increase their investment universe. So hedge funds, real assets, private equities. That's all these are the major types of investments, right? But perhaps in Asia, we have more focus on the real assets, for example, real estates, right? So they want to know more about this AI, yeah, and then how to put it into their portfolio. And also for the retail or maybe the private banking, we also have students from those private banking sectors and also from the retail banking sectors as well. All these practitioners in the markets, they also want to know more about this AI because there's increasing amount of demand from the market for that type of products. Yeah, in particular is the private banking. Yeah, they have been a major driving force to deliver these AI products to their clients. Yeah, so we have various private bankers joining our course to take the CAIA exam. And also we have students from insurance company, from the private equities companies. Yeah, they are already in the market. They're already in the market, yeah. But obviously the CAIA qualification is very important for them to demonstrate their professionalism, yeah. And also we have people from the compliance department. Yeah, it's not exactly government, but it's compliance. Compliance department in the asset management firm, for example, yeah, in order to cope with the ever-changing demand of their compliance jobs, they need to know more about this AI. So they also join this preparation course to prepare for the CAIA examinations. So the growth of the AI markets has the implications on various sectors, yeah, both the investors, the buy side and the sell side. And in terms of the growth in the past, as you can see here, there's some numbers for you. Well, currently around 10%, yeah, the investment universe, the global investment universe, yeah, related to the alternative investments, right? Here, this is is a result of the tremendous growth in the past 10, 20 years. So here it says it's doubled from year 2003 to 2018. In 15 years, the size of the AI market doubled, yeah, which is a lot. Considering in between there's a Lehman Brothers crisis, the global financial crisis in 2008, so which caused a dip in the size of the market. But since then, the market has recovered and with very impressive growth. And by now, yeah, if you talk about those institutional investors, yeah, like the insurance companies, pension funds, some of these large funds, they have allocated nearly 30% of their portfolio into the AI. Yeah, not to mention if you look at this, those endowment funds in the Ivy League universities in the United States, their allocations to alternative investments is more than 50%. Yeah, more than 50%, right? But of course, what I'm talking now is the largest endowment fund. For those smaller ones, yeah, maybe the allocation is not that much, but probably in the region of 30 to 50. Yeah, for some practical reasons that they cannot increase their allocations to over 50%. But anyway, it demonstrates that the share of the alternative investments in those institutional investors' portfolio is quite substantial by now. And also, it is still growing. It is still growing. And here, according to this survey, it is expected that the AI, yeah, is going to account for about 18 to 24% of the global investment universe, right, by 2025. Yeah, which means that more and more monies will be put into the AI sectors. Yeah, so which will have a stronger implications for both the buy side and the sell side. And here is the breakdown. Yeah, when we say this is a global investment universe, yeah, or the global investable markets, you see the traditional assets here and also the alternative assets here. I think that this data is referring to a couple of years ago. Yeah, but anyway, I think the ratios, the proportion is still the same nowadays. And it says that traditional assets in total accounts for about 102 trillions, and the alternative investments accounts for about 13.4 trillions, which is about 12% of the investment universe. And in the traditional assets, back in my old days, we mainly invested in the equities and fixed income. Yeah. But nowadays, the alternative assets, right, private equities, hedge funds, yeah, these tools are the pillars, yeah, or were the pillars, or have been the pillars of the alternative investments universe. But recently, in the past few years, you see these real assets and infrastructures has caught up a bit. Yeah. So nowadays, when we talk about AI, mainly is the PE, hedge funds, and these real assets. Okay. But of course, you can find various types of structured products around in the markets. Yeah. To cater for different investment demands. And we also study the structured products in the CAIA curriculum. Okay, so PE, private equities and debt, hedge funds, real assets, including real estate, and also the structured products. Yeah, these are the major types of alternative investments included in the CAIA examinations curriculum. These are the major reasons, yeah, why you see increasing amount of money has been put into the AI, yeah, for diversifications, for performance, inflation hedge, or yield enhancements, right? But it's not every single type of AI can deliver, yeah, all this. It really depends. It really depends, yeah. As in general, you see that for diversifications, we look for hedge funds mostly. Yeah. If you want to improve your performance, we look at, well, PE and VC. Yeah. Recently, I think there's a lot of story in the market about this unicorn. So venture capital is those investment vehicles for investing in unicorn. Real estate and infrastructures, mostly for inflation hedge sometimes, but also for steady income as well, as a proxy for fixed income investments. And lastly, for yield enhancement, we can go to the private debt. Okay, so it's not exclusive, right? Yeah, of course, some hedge funds can also deliver good performance, can also deliver yield enhancements. It depends on what type of hedge funds, what type of strategies are we talking about. So moving to level 2, I think particularly, yeah, the curriculum will start to focus on how we can make different types of hedge fund investments, strategies to fulfill different type of investment objectives. Yeah. So to differentiate between this level 1 and the level 2 curriculum of the CAIA, most of them, the level 1 curriculum refers to, you have to know what these are. Yeah. Yeah, what types of alternative investments are there? What are their characteristics? What's the markets like? Yeah. And then moving on to level 2, yeah, then we are going to make use of this AI, yeah, and to see how we go about, yeah, to get this diversification, performance, inflation hedge, and yield enhancements. So from what to how, from level 1 to level 2. Okay, so after passing the examinations, yeah, you got the qualifications, right? Yeah, qualification, of course, it is a professional qualification, so it is a recognition of your achievements. And I think the good thing for getting the AI, the CAIA charter is the market is still growing. The demand for the CAIA members, is still growing at the same pace. So it is a growth market, that you are looking at, And at the same time, you join the CAIA, become a member, the networking opportunities, because when the market grows, you want to find out more, If you're a CAIA member, there are various types of events, activities organized by the CAIA, like this. They will give you a lot of opportunities. Well, not just to chit-chat, not just to know people, but also they are very, very useful, practical seminar. But nowadays we have webinar, most of the time, but usually we have seminars physically, So you have all these different events, activities, helping you to build up your network, helping you to keep update of the market, and will be very useful, The membership, by now, it should be, more than 11,000 worldwide, worldwide, starting from a very low base since 2004. So it is a very tremendous growth, and it is the second largest investment professional organizations worldwide. Okay, here I want to give you a bit more details of the level 1 and level 2 curriculum. Particularly for the level 1, here you see that is what I refer to. In the level 1, you need to know what they are, the real assets, hedge funds, private equities, and structured products. Quite a lot of details, some of these you have to memorize. Yes, you have to memorize. Sometimes the questions comes out is like is a definition type of questions, right? And some other questions might be in terms of the concept you have to understand, and then you have to do a bit of calculations, And I used to get the questions from students, concerning whether it is very quantitative in the examinations. But as the CAIA always try to clarify, in the examinations, calculation is not everything. In fact, it only accounts for about 30% of the curriculum. No, I mean 30% of the questions in the examinations. So I think more importantly is you understand what they are. You know what they are, and some concept could be quite technical, but understanding of the concept is very important. And then the next part is the calculation, how to apply the concept. And that part will account about 30% of the examinations. Okay. So apart from this real asset, hedge fund, private equity, structured products, a little bit of calculations. And I think most of the calculations will happen here. Introductions to the AI. Before we talk about the specific alternative investments, we need to know how to look at the returns, how to measure the returns, and also the other side is how to look at the risk and how to measure the risk. And most of the time, retail investors look at the returns and keep trying to find this the highest returns products in the market. But then again, as a professional, we all know that might not be the best way to manage money. Return doesn't come along without risk. So return on one side, risk on the other side. We are going to go through all these different type of measurement of return and risk in this session. And therefore a bit of calculations will be done here, and also some statistics concept will be introduced here, so that we can make use of all these different quantitative things to understand the real asset, hedge fund, private equity, and structured products later on. Okay, so that is the level 1, and the level 2. It is how to. It's more a top-down approach now. Previously in the level 1, we take a bottom-up approach to understand all these different building blocks that we can choose and put it into our portfolio. And now come to level 2, we are really doing this mixing. putting different building blocks into the portfolio to achieve certain investment objectives like diversifications, performance, or yield enhancements. Okay, so you need to know the interaction between the alternative investments and traditional investments. And when you put this together, you have to measure how much more risk that I'm putting into the portfolio, or how much risk that I'm taking out from the portfolio through diversification. Okay, so these are part of these asset allocations from the perspective of the investors. And also very important and also very practical is due diligence. How to select different strategies. Hedge fund, for example, is very generic terms. Within hedge funds area, there are a lot of different strategies, and they can produce a lot of different risk-return profile. So even within the same type of strategies, the performance of the managers can vary quite a lot. So here, up to the level 2, we come to this realistic, practical bit of the investing. Yes, you do your due diligence. You find the right strategies. It's not just about understanding what they are. You have to make a judgment as to how to apply this into the portfolio. And then there will be some other current and integrated topics, which might not be part of the curriculum elsewhere in level 1, level 2, but these are quite controversial, and the CAIA members are expected to have certain knowledge of those areas. For example, fintech, cryptocurrencies. Well, that kind of topics are what we call is the current and integrated topics that you might come across in level 2. Okay, so much for the curriculum of the CAIA examinations, and then I expect you, since that you attend these information sessions, you might already have registered for the examinations. So here, the fees, I just put it down here for your reference, and also the days, right? The deadline and the examinations days, right? For level 1 is in the last week of February, last week and the first week of March, and also for level 2 is the second week and stretching to the third week of March next year. Passing rate, roughly about 50%, and I don't know why. Last year suddenly the passing rate for level 2 up quite a lot. Well, there's no official answer. But okay, we'll see whether it can continue. Okay, coming here to Kaplan. Kaplan is here to expedite your studies. Help you study faster. Efficiently, so that it enhance your chance of success. Because sometimes it's quite strategic to pass the exam. It's not just about studying. You have to study very efficiently. We all work. We all have limited time, resources for the examination preparations. With all these constraints, we have to come up with our study strategies. To enhance our chance of success. We don't work hard 24 hours a day and 7 days a week. No. It is quite hard working, but is it efficient? It might not be. So we have to be very disciplined and focused. And sometimes we have to be very flexible. Coming to Kaplan, our course is quite intensive. For the CAIA, for example, the level 1 examinations preparatory course, we do it during the weekend. Probably we're going to stay together about 5 to 6 weekends, about 6 to 7 hours a week. So altogether there will be about 36 hours for the whole course. For the educations of the whole curriculum. So that is the classroom tuitions. But then again, you can also choose some other online options, which my colleagues will introduce to you later on. And on top of that, we have some materials prepared, which we think it is more effective. Study materials for preparing the examinations. Yeah. And at last, we have the mock review, yeah, for all our students to have the experience of taking exams, yeah, to make sure that everything has been checked and nothing has been missed out. Yeah. Okay. Yeah. And what comes next is a few slides, yeah, to highlight, yeah, how we tackle a couple of topics in the curriculum. Firstly, yeah, it is about the risk measurement. Risk measurements, as I just mentioned, that in level 1, there's a session is the introductions to alternative investments. Well, actually, most of my students found that session is quite difficult. Yeah, it's quite difficult, and also it is quite a lot. Yeah, it's very comprehensive foundations. Yeah, for students. Yeah, I think that is also a very good foundations. No matter you want to focus on alternative investments or traditional investments. Yeah, these are the foundations you need to learn. Yeah, by heart. Yeah, and here I have chosen this risk measurements. Yeah, to demonstrate to you. Yeah. When we talk about the topics, first of all we need to know what is the expectation in the curriculum. Okay, and here, for example, for risk measure, there's a lot of different measures, and one of those is called VAR, value at risk. Okay, it is a measure. Value at risk. What do we need to know about the value at risk? Here it says that, well, there are more than one methods to calculate the value at risk. And most of the time, we apply this approach, the parametric approach. So we need to know what is the parametric approach. Yeah. Well, perhaps we also take note of those non-parametric approaches as well for comparisons. Yeah, that is the normal question format. That in addition to the understanding of one concept, you need to evaluate or discuss the concept. Yeah. So for parametric approach to estimate the VAR, yeah, you need to understand this, and also you need to be able to compare the parametric approach to other non-parametric approach. And in calculating this approach, we need to, one of the major input is the volatility. Yeah, how do we look at these figures, the input? Yeah, how does this input affect the output? Okay. And also, under what conditions this VAR calculation is valid or not valid? And then you move on, to talk about different type of the VAR approach here. So you see, this is the requirements, in the curriculum. Yeah, with these requirements, then during the classroom we discuss the VAR. Yeah, we want to look at the VAR. We want to understand what it is. Well, here you say it's the maximum loss over a specified period with a specified probabilities. So for those of you who have no background at all in the statistics, maybe you need to spend a little bit more time on this. Yeah, well, in fact, when we do these topics, before we do these topics, during the classroom lectures, we already gone through the statistics, so it should be easier during the class. But here, of course, we just have to focus here, to understand this. Well, we say that is the expectation. Yeah, in the normal circumstances, that is what you expected to get, right, from your investments, right? If you get more than this, then you have more gains. Yeah, if you get less than this, you have more loss. Okay, so that is very, very natural that if you do investments, okay, there's a chance that you gain, there's a chance you lose, right? But for the value at risk, you want to, have some kind of a cut-off point here. Yeah, cut-off point here is kind of a statement that you can make. Yeah, the maximum loss, the maximum loss, that relates to the value at risk, under what circumstances, under what conditions, is over a specified period, or might be within a day, in one trading day, or in a week, or in a month, and what is the probabilities, that you say that is your maximum loss, because when we come to this risk measurements, we can never be 100% confidence, right? Nothing is 100%, nothing is guaranteed, okay? So we can only talk about probabilities. Okay? So that is the maximum loss over a specified period. It could be a day, a month. You are going to specify it, or the questions will specify it for you, and how much is the confidence to say this is the maximum loss, and that is the probabilities. So put it down into the equation. That is the calculation bit, right? This is what we try to work out, the maximum loss, subject to, here is 3 things. 1, 2, 3, okay. 1, 2, 3, The C value, well, the C value is related to your level of confidence. You want to specify with how much probabilities, your confidence level, that the maximum loss should not exceed by that cutoff. And that is the volatilities. Of course, the more volatile the investments in your portfolio, the higher should be the VAR, and that is the specified period. Over how long that you think your maximum loss might incur, right? So the longer the period, the larger should be the VAR. Okay. So these 3 things, basically, the more confident that you want to be, the more volatile of the investment in your portfolio, and the longer is your horizon, usually, the larger will be the VAR. You see this relationship, right? The questions might ask more on this relationship rather than the calculations. And here is a very simple example, telling you if the in the examination, the questions give you all these inputs, right? This is the horizon, 10 days, in 10 days time, your confidence level is 95%, and turn it the other way around, we call it the significance level is 5%. So 1, 2, and also you need one more input, which is the standard deviations, okay? With these 3 inputs, you put it together, to your portfolio value, you work out the VAR. That is the maximum loss that you expect that the portfolio might suffer in 10 days time with this 95% level of confidence. Okay. So, we can go through this in more details, right, in terms of the concept, VAR limitations, and these are the requirements of the curriculum. And also, when we put it in the portfolio context, and what we have just worked out is on the individual investments, on one investment, right? But in a portfolio, usually there's more than one, right? There could be 10, 20, or might be more than 100 different type of assets. So we are going to work out the portfolio VAR. No, that is not the curriculum requirement. That could be quite difficult, very technical, I can assure you. But then again, even though we are not required to work out the portfolio VAR, but we have to understand when we put different assets together, how does this impact the VAR at the portfolio level? And here what we're talking about is the correlations among these different assets in the portfolio. And very simple, when we talk about correlations, it could be perfectly positively correlated, which means the correlation coefficient is 1. On the other side is -1. So we have to make sure that we understand this relationship. When this correlation is 1, the total VAR is the portfolio VAR, basically. is the sum of the individual VAR, right? If we have two asset A and asset B, if they are perfectly positively correlated, the portfolio VAR will be equals to the VAR of asset A plus the VAR of asset B. No diversifications, right? That is the conclusions. But as long as the correlation is less than 1, there will be diversification. Then we have to understand, how this VAR will become less at the portfolio level. So it is another things that we have to pay attention to on these topics. And one more topics I want to mention here. Quite a lot of structured products make use of the derivatives, particularly is the options, options, right? And with the option in the portfolio, it makes the VAR calculation even more difficult, because the option payoff is asymmetrical. It doesn't follow this normal distribution assumptions. And that makes this the parametric approach not work. So with these options, in the curriculum, the introductions to the AI, we are also required to understand options, the payoff, how it makes the portfolio different from the traditional investments. So to understand this, we have to understand it from this foundation level, which means during using a structured products, which might have embedded options, or might be in a structured product, it might have a long or short position, long or short positions, call or put options. These are the building blocks, for various kinds of structured products. Okay, so with these different building blocks, you can have different strategies. Okay, you can have different option spreads and option combinations. Okay, so these are the strategies, and we have to understand what these strategies for. And lastly, a little bit on the parities concept, which is used for valuations. Okay, so the curriculum requires us to have the knowledge of these building blocks, some strategies knowledge, and also about the valuations. So the building blocks here, that is the payoff. A long call. Long means that you have this, you bought this call position. You bought this call option. You have the position of these call options. So when the option expire, you have the right to buy the underlying. So when the underlying price goes up here, it will be profit to you. So that is what we are going to discuss during the classroom. With a long call, short put, long put, and also short call. So with all this combination, you see this profit or loss is represented by the red line, right? So long, short, put, call can come up with various combinations in different quantities. Okay, if we put them together with different quantities or might be different maturity date, there will be a lot of different combinations, for us to structure different products for different investment demands. So for example here, if we put the underlying with the call together, you see we have a new profit or loss payoff from the strategies, which is the result of the red line and the black line. And this is something that we're going to discuss in details during the classroom. And some others more, a little bit more technical strategies is, it's just not just one options. You can make use of more than one options with different strike price. And here we have some examples here. We have well, it's either call or put. Let's say it's a call options. Call option, if we long a call at the low strike, short a call at the high strike, one long, one short. So that means that, yeah, it is the low strike. When the underlying price, for example, the stock price go beyond this low strike, you start to make money, yeah, but you don't think the stock price will go beyond that, yeah, and that is the high strike. So if the underlying stock price did really go beyond that high strike, yeah, any further gains will not belong to you. Okay, so what we call this is the bull spread. Yeah, you have a mildly bullish view on the underlying, but not very much bullish. Therefore, you can make use of this type of option strategies to make money, yeah, to maximize or to monetize your view. Okay, lastly, we also discuss questions during the class. For example, this one, which one of the following strategy is the best way to hedge the risk of the commodities producer's debt? Okay, going into default. While you have the holdings of the commodity producer's debt, you earn very good coupon interest, but you are afraid that the producers might, currently some commodity producers might have some business difficulties, okay, and as a result they might go into default. How can you hedge your debt exposure in this case? Okay, therefore we have to go through these options, choice A, B, C, D, to see which one is most appropriate. And based on our understanding what a call option is, what a put option is, we know call option is give you the right to buy something, right? To buy, you don't want to buy something because you already bought something. So probably the call option is not quite right. Put options, well, maybe. Futures, how about futures? We haven't talked about futures yet here, but that is another type of derivative that we need to go through in details during the classroom, okay. And just for your information here, the answer is C. If you want to know why, come to join our class, then we'll discuss further. All right, that is pretty much about the materials that I have prepared for these sessions. You're welcome to raise any questions in your chat box. Next, I will pass it to my colleague, and she will guide you through all these different offerings by Kaplan's for you to choose, to prepare for the CAIA examinations.